tell me about who loses in this. Who's the loser in all of this? Because clearly the companies benefit, the employees of the companies benefit because they don't suffer dilution. They build a war chest. Obviously, as an angel investor and a person who owns an accelerator and does Series A and maybe sometimes keeps the pro rata in Series B, this is like, mark it up. Let's go.
Yeah,
you know?
Let it ride.
Let it ride. Sure. You want to take like, you know, my little plot of land here and you want to build a skyscraper on it? Build away. Yes, let's do it. Break ground.
So
who loses?
Yeah, the who loses. So the reason why I really wrote this piece was every single week for probably the last 6 to 9 months, I would talk to an investor friend at some fund and we would have the tiger conversation. And it was like, oh my God, we lost a tiger. Can't believe this founder's taking the term sheet. Oh my God, they're overbidding. We couldn't get through our diligence process, just all these excuses. And, eventually I kind of stopped nodding along. And I respond and I'm like, well, one, do you really think that these people that have been very, very successful for 2 decades in the public markets just come into the private markets and lose 50 IQ points? Probably not. And then 2, what are you really offering founders that they can't offer founders? If you don't have the brand, if you don't have the signaling, if you don't have a lot of these really special things that really only 5 to 10 firms have in the US at least, I don't know about Europe or other places. If you don't have those things, what are you really giving them that is better than what Tiger can give them? And when you dig even just on those things a tiny bit, it was very clear that many folks in the industry just hadn't thought critically at all about the state of this asset class. So for me, it was kind of like, wow, a lot of people are kind of riding blind and are asleep at the wheel. So I'm not going to name names. At Founders Fund, we try just to care about our LPs or founders and ourselves. And we don't really care what other folks are doing in the industry, but there's kind of these common attributes. And so you can kind of tell a firm if they are really, really pitching a lot of value add services, if they don't have the brand of a top 5 or a top 10 brand where you're really signaling to the market, wow, Founders Fund is investing in this company. There's probably 10x upside left after this. There's probably something very special about the business. And if you're not nimble, if your organization structure isn't set up such that you can adapt to these new competitive realities, that is what that is what happened to JCPenney. JCPenney they went through bankruptcy. They tried to come back, but they couldn't. They didn't have the management. They didn't have the employees that were ready to be nimble and really shed a lot of that weight.
When I saw your piece, it immediately was cathartic for me because when I came into the industry 11 years ago as an angel investor scout, and I started placing bets, I was amazed that the VCs over the last 10 years just decided to go downstream. And they were like, you know what? We're not going to demo days anymore. We don't care about, Y Combinator demo day and stuff. Just literally had somebody at a very high profile firm who but I won't say who, say to me, that's an awesome company. I totally want to be on the cap table. Get to product market fit and I will overpay for the Series A or Series B. But I don't want to do all the work for these first 2 or 3 years of that product market fit journey. And I said, I happen to like that. And I was offered to go to one of the firms that had more of a growth thing. And they were like, you could, instead of, trying to put 25 or 50 million to work a year in 50 companies, JCal, you could make 1 bet or 2 a year and then just hang out the rest of the year. And it's the same amount of money being deployed. And I was like, I kind of like the earlier stage better. So basically now there's just going to be this demarcation. If you have product market fit, if you've got tens of millions of revenue, you're basically going to a bank and getting financing, as opposed to in the early stage when you really do need to have some help in terms of, hey, what's the business model here? Or what, why is our design suck? Or how do we grow this thing? Or do you know anybody who could be a CFO?
Or at least it's an option, right? Maybe, every time you want money, maybe you don't go to the bank of cheap capital because maybe there is somebody that can really move the needle with your business, or really, you really get along with an investor and you're like, you know what, we're going to be $100 billion company, 2 extra points of dilution doesn't matter. But I think it's a healthy thing for founders. And that's all we really care about, at least, is it's a healthy thing for founders that this is available. And if they want to take it, they can, because it's a better product than what a lot of folks are putting out there.
In the early stage, people were lamenting, oh my God, angel lists and syndicates. No founders will ever do those. that's going to be negative signal. And now, of course, syndicates are a vibrant part of the ecosystem. And then equity crowdfunding, people are looking at that going, oh, that's just silly. And then we saw Sahil raise $5 million in a day with there's no venture partner in that model. When you do a Republic or a seed invest, there's no investor. That's just the founder selling directly to the public. So do you think there's something similar or analogous here that could happen a little bit earlier? Or is the earlier stage just so much work that it's not as easy as a, what's your revenue? Send me your P&L. Send me your CAC. Here's your check.
I think it'll be a mix, and I think that because the every round size is getting bigger. Like seeds, as you mentioned, there's kind of this like what a seed is today used to be an A. What an A is today used to be a B. So you just have a lot more room to work with. But I do think that there might be this kind of like mix of where you get the institution that you want, you get the signaling of the institution, you get the board member that you want, you get the brand, you get all that stuff, but you still have room to involve either if it's individuals or people with rolling funds, angel list, et cetera, also in the round. And so maybe now instead of a seed fund or a seed A fund doing all of a round, you have them be the lead, and then you have 30 to 40% of the round also allocated to all the other things that are popping up. Because I think there's a lot of individual value add that some of these folks, especially it's like you have some people that are just absolute experts, whether it's in a sector or at a function, and you're like, wow, like I just want to know their marketing network because you don't know any marketers, and that's what you're going to be focused on for the next 12 months. Why not give them a little bit of allocation like that? I think that makes a lot of sense, and there's just a lot more room to work with these days than there was previously.
It does feel to me like the middle layer of this capital stack has just been absolutely squashed. It's just, there's really, if you don't get into those early rounds, you're not getting into the startup end of the day. Like if you look at something like, I don't know, Clubhouse, the hottest deal of the last year. Kind of weird to have Andreessen do 3 rounds in 14 months from 100 million to 4 billion with no revenue and collapsing downloads. Putting that aside, you're not in that deal, I take it.
We are not. We are not in that deal.
Yeah. If you didn't get in that $100 million seed round or whatever it was, like you're not getting in now, right? It's like the ships, unless the founder just absolutely loves you and wants to carve out a little 25K or 50K check for you. Either you get in early or you don't, which in a way I kind of like because it makes investors take risk, which I took huge risk in my bets. I invested in Calm and Uber and Robinhood and these things before they had product market fit. And then everybody wants to be a hero and invest in them when they're at $1 billion and then put them on their in their bios. And I'm like, I kind of know that you bought secondary shares on like some website.
Happens all too often. Yeah.
You don't get to call yourself an angel, in Airbnb because you bought it 3 months before the IPO.
Well, I think it brings up another good topic, which is the third avenue, which is they can come in over the top and really overpay, just like Tiger. And I think what some of these JC penny funds are already doing, and we'll see a lot of them do, which I think is a bad response to kind of the Tiger phenomenon or the crossover phenomenon, is they will try to emulate it. They're going to say, you know what, we need to get in these hot deals. Let's overpay. Let's quicken our diligence process. Let's keep getting into these deals. And when you don't have the scale of Tiger and you don't have the index fund where you're invested in 100 of these things instead of 6, you can get wiped out if you miss if you miss a swing or two. And
this is going to be the risk of it. Yeah, this is going to be the risk of ruin, right? Like you're going to overpay, and entry price does matter in a smaller fund, whereas a big fund, they can withstand it. They hit one Zoom or one Airbnb or one Coinbase, like they can withstand this, and they're also playing with tens of billions of dollars in capital, of which this is going to be 5 billion, right? And it's just not going to be as much of an impact on it.